Let's bring in Jeff Kilburg, founder and CEO at KKM Financial. He is also a CNBC contributor. Jeff, let's talk about the strength in markets right now. Does this rally off the Christmas Eve lows still have legs?
You know what, Dom? It's amazing to see this rally you talked about after Christmas Eve, and I think it still has a little bit of legs, but I'm very cautious going into it. And there's three reasons why I'm cautious. There's just a lot of emotion in the market. Secondly, all the trade expectations, these trade tariff conversations, we have high expectations. If we don't see what we want, if we can't sink our teeth into something, then we see a pullback. But lastly, I think it's very important to remember the Fed has rewritten the narrative for 2019. Therefore, as long as we stay above this 200-day moving average, which is about 2% lower than the S&P 500, around 2740, I think it continues to attract investors and build confidence in the marketplace.
You're a trader. You watch these momentum indicators, and the momentum has been strong for a long time. A lot of traders pointing out the idea that we are in statistically rare scenarios for market moves above their moving averages. Does that give you at least a bit of pause about what's happening right now?
I think that's right, Dom. Whenever you see the VIX go down to 14, that anxiety that we know is just under the surface. It's really important to understand, and we run a lot of ETF model portfolios really justified by relative strength. So it's been wildly fascinating to see the movement in relative strength, but we're still consistently allocating towards the technology, the healthcare, and believe it or not, utilities right now. That's really been lit up on our sector rotation. I think it's really understandable that investors have a second chance, right? In December, a lot of people got caught off guard. Right now, the market has really repaired that damage. So here's a second chance to rotate out of sectors, but also to dig down and find some names. Look at like a Palo Alto, PAN Networks, PANW. There's a name in the tech, maybe it's not the Amazon, maybe it's not the Apple, that's been lopped off 20% in market cap, but there are some hidden gems in the tech sector still that you have to deep down and dig and find.
One of the things that we've been noticing over the course of the move higher since Christmas Eve has been the real outperformance so far of small and mid-cap stocks, even versus the S&P 500 and Dow, despite their nice run-ups. Is there still a chance for opportunity in small and mid-cap stocks, given the fact that they're already outperforming?
Well, I think if you look at an ETF like IWP, certainly it's up about 17%, wild ride moving forward. But the real undercurrent, and I want to bring it back to Chicago here, to the interest rate market, look what's happened in the 10-year note. Those lower interest rates have really helped those smaller companies. And it's interesting to see, you go back to the data in November of 2018, we are seeing the lowest percentage of holdings by foreign buyers, primarily China and Japan. But when you see that lower holding of those U.S. Treasuries, that's when the government, that's when the Fed really got a little bit nervous. So that backstop by the Federal Reserve is going to help all those small caps and those mid cap stocks continue to move higher. And until the Fed actually raises rates, which I don't foresee anytime soon, I think it's going to continue to see that trajectory. But let's be honest, Dom, markets can't go straight up. So I think you will see a little bit of a back and fill. Watch that 200-day moving average on the S&P 500. There's a big gap all the way down to the 50-day moving average. So that's about 150 points of a gap, or an air pocket, if you will. So I think you have to be very mindful of that, because a lot of stops hide underneath that 200-day moving average.
All right, Jeff Kilburg, always great to get your thoughts on the market. Thank you very much, and have a nice weekend.